Menaka, we're awaiting GDP figures as well. What are we expecting in terms of the health of India's economy?
Well, it's looking good, Paul. We just got the first advance estimate for the GDP growth for FY26. That's the year ended March 31st. It's come in at 7.4%. That makes India the fastest growing major economy in the world. That growth is coming on the back of renewed government activity, because the year before that, government activity was subdued on account of a national election. We're seeing some signs of pickup in corporate investment. Services, which is the backbone of this economy, has been strong, and there has been an upsurge in manufacturing as well. Now, we spent all of last year, Paul, talking about the trade trauma that India is facing on account of the 50% US tariff that President Trump has imposed on India. That did not have a significant impact on this GDP estimate for a couple of reasons, and I'll run through them. Firstly, India is mostly an inward-looking economy. At worst, economists had estimated an up to 0.5 percentage point impact of the US tariffs. The consensus was between 20 to 30 basis points. A couple of factors playing in here. Key sectors like electronics, pharmaceuticals, exempt from those tariffs, and job-intensive sectors like textiles, gems and jewelry that were impacted by the tariffs did do significant front-loading ahead of the tariff becoming effective. So we haven't seen the full impact of that play out on the Indian economy, and even if it does, it's not going to be significant. So here we stand at 7.4%. The bigger question is, what will next year look like? And I can't think of a better person to answer that than Arvind Subramanian, former chief economic advisor and also, more importantly, co-author of a seminal book on India's economic history, A Sixth of Humanity, Independent India's Development Odyssey. Arvind, thank you very much for your time this morning on Bloomberg.
Thanks for having me, Menaka.
Let's start with that 7.4% number. What's your quick takeaway from that? But more importantly, what does that mean for the next fiscal, the one or two things that you're looking at closely?
Well, firstly, can I just sound a note of caution on the 7.4 number? I think there are two things that that number which should make us read it cautiously. One is the age-old issue of is it well estimated? Are the deflators right, etc., is one. But even directionally, as you know, it's not obvious that the economy is recovering, because for one thing, all the nominal indicators are decelerating. Even nominal GDP is decelerating, and many of the high-frequency indicators are also slowing down. So I think we should be cautious about both the level and the direction in which the economy is headed. And of course, remember that one sign of caution, of course, is that in the last few months, the rupee has come under pressure. Now, it would be very, very odd for there to be capital fleeing a country where apparently the growth is 7.5%, which is so much greater than anywhere in the world. Something odd. Those two don't completely connect. So just a note of caution about where we are even today on the performance of the Indian economy. Now the next question, looking ahead. I think one has to be a little bit anxious, because let's not forget that India has suffered two major external shocks. And let me explain them. The first, as you said, Menaka, very rightly, is the tariff shock, which is, as you rightly said, the headline number is worse than the actual number because of the exemptions. But on the other hand, it's now looking less likely that there will be a trade deal than more likely. And it's maybe looking likely that, the tariff numbers may be headed upwards too. So I think the tariff shock has has not gone away by any means. That's the first shock. The second shock is, of course, Chinese mercantilism, that China has started exporting very rapidly, and it's diverting its exports to developing countries, including India, and that too will put pressure on India. So I think that one has to be a little bit cautious. The fiscal deficit has deteriorated, for one thing. So the macro position is, while it's reasonably strong, it's not as, the fiscal situation because of the GST cuts is not as strong as should be. The million dollar question going forward is when and how will private investment recover?
And you don't think, or you don't agree that there are signs already of a very nascent, recovery in private investment?
Well, the order numbers are up, but, remember, real credit to industry has again decelerated from not very high numbers. So we'll have to wait and see. I can't, let's put it this way, I can't be confident in saying that I see a recovery. If anything, many of the indicators are, especially the nominal indicators, are slowing down. Electricity, for example, has slowed down considerably. Consumption of steel has slowed down considerably. So, but that's not to say other indicators have not recovered. But on balance, nothing that will give you confidence that there's a serious improvement in private investment. Because, and this is where I think the connection with the book is important. What is one's diagnosis of why private investment is weak? Because remember, the macro is sound, the banking system is flush with money, public infrastructure has been built up, and yet private investment has been weak and not shown any sign of sustained recovery. So the question is, what is the diagnosis? We have a diagnosis that stems from the book. I'd be happy to share it to sort of strike a slightly note of caution.
Yes, well, you've written, extensively in the book of how India has throttled private enterprise, and even the deregulation that took place after 1991 wasn't adequate. We are in another round of deregulation right now, Arvind. I want to bring it to the now and present. Do you feel that the government is gripped significantly with all the challenges that you've listed? And I can add to that, right? For instance, the GDP number suggested that there has been a moderation in consumption, though this year we had hoped that consumption would in fact pick up on the back of that the series of tax cuts. So do you feel the government is gripped enough, is doing enough, and what more does it need to do?
Correct. I think it's a very fair question. I think the government deserves a lot of credit for having recognized that, the combination of the domestic economy and external shocks requires a really serious policy response. And to their credit, they have responded very strongly. For example, they cut GST rates to boost consumption. They have cleaned up the labor codes, which was long overdue. And most importantly, they repealed these horrendous quality control orders, which were just a form of naked protectionism. And they've also enacted, a reform of the insurance sector, the nuclear liability, and so on. So I think policy-wise, the government has responded because it's aware of how serious the challenge is, how, adverse the external market has changed. But Menaka, the key question is, will investment respond? And here's where, I've written in the past that my diagnosis of why private investment is weak is because the risks of doing business in India still remain elevated. And what are those risks? First and foremost, arbitrary government action, weaponization of the state to target, groups and so on, which is spilling over into how investors feel, if they were to make long-term investments, are they secure that, something will not happen to undermine those investments? The second big reason is something we've called national champion risk that favors to some big companies and groups, has dampened the incentive of other investors to enter the space where these big conglomerates are. So that's why I think that's another thing. And of course, policy policy reversals keep happening, and therefore protectionism being a good example. So the government really has to work to reduce the risks of doing business. It's not just about increasing the returns, which they are doing to their credit. Corporate taxes were cut, and all of those things. But is the investor environment less risky, or do the risks remain elevated? I think that's the million-dollar question.
All right, assuming that the government, is aware of this and will work towards it at whatever pace, that an economy like India allows, Arvind, what do you expect will be the growth outcome for next year? Because markets are forward-looking. This 7.4% number is backward-looking. Everyone is expecting on this base a lower number. What are you looking at? Like close to 6%, 6.5%? And what role will inflation and the rupee play in this?
Yeah, let's turn to the rupee for 1 second. There's been a massive external shock. As you know, some labor-intensive sectors have been pretty badly hit: gems and jewelry, apparel, fisheries, and so on. So, what the export sector needs is support. There are two ways it can get the support: either via the government, which now is less and less in a position to provide that support. That's why there hasn't been much. Or the support comes from a declining rupee because, as you know, a depreciating rupee is an export subsidy, right? But, the Reserve Bank still seems to be reluctant to allow the rupee to be fully flexible. And I think that's a policy response that needs to be looked at more carefully. So that's on the response side. One has to be cautious about next year. I don't want to put a number. I think if at the end of the year, the growth numbers are similar to where they were this year, I think India should consider itself both lucky and job well done, because the uncertainty has gone even higher now. I mean, there's threat of a 500% tariff on countries buying Russian oil. So I think that's going to be very important. Now, Menaka, one thing, can I just a little bit push back at something that you said, that, so
Sure.
far the impact of the tariffs have been small, right? And you're right. I mean, so far, it's short run. But, in the medium term, the impact of this tariff shock should be viewed not from the perspective of, how much exports have we lost in the short run, but rather what it does to the long run China plus one opportunity. Remember, India was very well positioned to take advantage of that, even in manufacturing. After all, the iPhone is a great example. But if, because of the tariff shock, because of the elevated uncertainty, even the risk that tariffs might go up, investors will be even less keen to relocate to India. So that foregone development opportunity is the real risk of the real cost of the external shock, as it were.
All right, we have just a few minutes left. So, Arvind, I want to ask you a quick follow-up question on the rupee. Are you saying that you think that the Reserve Bank should have allowed for faster depreciation, well below the 90 to the dollar level? Because, there has been considerable intervention, but the central bank says it's simply to smooth out volatility.
Yeah, I think, the last 6 months have been better than in 24 and 23, when the rupee was basically the de facto pay. This is better, but there's still been a lot of intervention. The intervention is well above what is required to make a smooth volatility, because the numbers are big, at least 30 to 40 billion on the spot market, similar amounts in forward markets. And we know they're partly responding to pressures not to let the rupee fall too much, because all nationalist governments don't like seeing a depreciating currency. So I think that I wrote recently that there should not be pressure on the RBI to target any level. There should be much more flexibility than there is, and of course it should not be dramatic. It should be gradual, because that is the only response to the large external shock today and in the future that India faces.
All right, one last question. We just have a minute or so. This is going to be the year of key state elections. You've written extensively about the center-state relationship in your book, Arvind. Investors will be looking to India to say, is this relationship souring? And does it impact, in many ways, autonomy of states, growth of states, and therefore the overall growth of India? Very complex, but can you distill your outlook in 30 seconds?
Well, there I'm a bit more hopeful, actually. While relations between the state and the center, there's been some diminution of trust over time for all kinds of reasons. However, states still have a lot of agency to undertake and attract investment. We've seen that already. Some of the southern states have attracted a lot of investment, even in manufacturing. So as long as there's kind of this competitive federalism, as it were, states, take the initiative, make the environment less risky. In fact, that's how Tamil Nadu and the southern states have been able to attract investment. They've reassured investors that if they come in, they will be protected in legitimate ways. And if some more and more state governments can do that, I think that is the hope for growth going forward, competitive federalism and actions by the states that the center has not been able to do, in fact.